Hi there, and welcome to our stock analysis on Netflix. They recently reported their second quarter earnings, and what we're going to do here is walk you through our three-step process so that you can better understand the quarter and hopefully be able to anticipate any moves to the upside or to the downside. Now, in terms of our process, step number one, we're going to be performing due diligence, and that includes going to the company website and reading the press release. Step number two, we're going to apply some of our technical skills and perform valuation using sales and PE multiple so that in step number three, we can come up with our own price target and investment thesis and help us anticipate the price action of the stock in the coming weeks and months, whether it's to the upside and to the downside. Now, before we get started on the actual content, I want to point out a lecture that we uploaded to our YouTube channel back in May, where we had a $500 price target on Netflix. And lo and behold, we actually got it right. Netflix exceeded the $500 price target. But it wasn't just only on Netflix. We also did it on Amazon, on Tesla, on Teledoc, on Zoom. And we have these lectures in our YouTube channel. So I strongly recommend that you go back and watch those lectures and pay close attention to the process on how we came up with a price target and how the stocks unfold and reach those levels. So we're basically 5 for 5. But again, what's important is the process so that you can internalize it and apply it at home or on your own portfolio and become a better investor with an objective perspective and have an execution game plan. And lastly, for those of you that are actually part of our analyst training program, this is going to be a great introduction so that you can understand a little bit more of my thought process and how I apply the technical skills that you're learning in the program real time to anticipate these moves and also formulate an investment thesis. So with that being said, folks, let's get right into the content. Let's go on their website, as you can see here on our screen. And if we scroll all the way to the bottom, you're going to find something known as the Investors Relations section of Netflix. I'm going to click on this, and it's going to pull up a little bit about the company, financial information for shareholders and investors. But right at the top, right underneath Investors Events, you're going to see Netflix second quarter 2020 earnings report. And we are more concerned with letter to shareholders. Actually, if we click on the title, you're going to see that they have 4 different categories that you can click on. But let's look at the letter to shareholders. If I click on this, it gives us detailed information about what happened in the second quarter. Net subscribers, revenue numbers, earnings per share, and then we are able to dissect the information, internalize it, and then assess what really happened during the quarter. So let's see here, fellow shareholders, and this is coming directly from management, the CEO of the company. You can see here, right, in the first quarter, let me actually pull up my pen so that we can highlight this a little bit easier. Let's see, can we get it right here? Yep, all right. So we live in uncertain times with restrictions on what we can do socially, and many people are turning to entertainment for relaxation, connection, comfort, stimulation. Okay, I mean, depend what they mean by stimulation. In Q1 and 2, we saw significant pull forward of our underlying adaptation, leading to huge growth in the first half of this year. 26 million paid net ads versus prior year of 12 million. So obviously the coronavirus has definitely helped Netflix increase their revenue growth, their net subscribers, because of the mandated lockdown order that we experienced in the month of February and March, and people had nowhere else to turn other than streaming online content. And Netflix obviously is the king of streaming with their own shows that they've been providing. Let's see, what else do they have here? As a result, we expect, this is important, this is forward-looking now. As a result, we expect less growth for the second half of 2020 compared to the prior year. As we navigate these turbulent circumstances, we're focused on our members by continuing to improve the quality of service, blah, 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 new film shows. Okay, so here they're giving us forecasts of what's going to happen in the second half of this year. And they're saying, hey, look, it's going to be less than what we experienced in the first half. And obviously, again, this all has to do with the reopening of the economy, people just being tired of staying indoors. They want to go out, they want to socialize, they want to do outdoors activities. I mean, we're basically human, we're social animals by nature. And many of us want to go out and not stay at home and just watch Netflix. I think I've done plenty of that already during the quarantine months that we were in lockdown. So this is what they're anticipating, and yeah, it definitely makes sense. But when we look at the actual results, here's what they reported in Q2, right? They're nice enough to highlight it and give it to us. Year-over-year revenue growth, 24.9%, okay. You can see here their earnings per share, $1.59, net income $720 million. And we're gonna be able to compare this with what the street was anticipating once we dive into our model. So let's see what else. In terms of global streaming paid membership, 192.95 million. Okay, very strong number. And here's the quarter-over-quarter growth, 27.3%. Compare that to the previous other quarters, right? Less than that number. But the street is always forward-looking. The market, stock, they're always looking forward 3 to 6 months in advance. So as you can see these numbers for the second quarter, what is management anticipating? You see here, forecast, Q3 20 forecast. Okay, so let's see, look at revenue growth. Comes down to 20.6. Let's see here in terms of subscriber growth. Here, look, it's down. And in the second quarter, they're expecting to add only 2.5 million. The last time they'd had a number below 3 million was in Q2 of 2019. So you're starting to see the weakness in the second half of the year, because the first half, because of the coronavirus being the influence or the accelerant from the numbers that they were probably expecting this whole year, happened in the first half of the year. Now the second half is going to be slower growth because, you know, the number of people that actually wanted to take on Netflix, they already did it. So they basically accelerated that process, and now you're going to see that deceleration in the second half. And this is probably one of the reasons why the stock, after they reported earnings, was down over 7% in the aftermarket hours. When we look at the charts, we're going to make sense of it. We're going to dissect what the chart is telling us, and this is probably one of the things that the market was discounting, is lower growth in the second half of this year. So let's look at another section of their earnings. Okay, so here we have second quarter and third quarter results. Anything here that's interesting that stood out? For year forecast guidance, let's see, as the pandemic delay plan. Okay, here, I think this is important to really understand what was happening on an operating basis. So operating margin expanded by 770 basis points, okay. Above our guidance forecast due to higher than expected, so we already talked about that, higher than expected membership in the first half. In addition, content marketing expenses were lower than expected as the pandemic delays some planned spend. Okay, we see that. Second quarter, more information here. All right, let's continue down. This is on a weekly basis. Yeah, you can definitely see the impact the coronavirus had on the number of subscriber addition. Look here, this is big time, right? Wow, this is a big jump. Okay, so let's continue. Let's see, what other key information they provided for the third quarter. Here it is. Here's more transparency and more information on third quarter. So we forecast 2.5 paid net adds for Q3 2020 versus 6.8 in the prior year. As we indicated in our Q1 letter, we're expecting paid net adds will be down year over year in the second half, and as our strong first performance likely pulled forward some demand from the second half. Okay, so the first half just took away some of the net adds that they were anticipating on the second half, and again, the main accelerant of that was the coronavirus. Anything else in terms of content production? I know they were halted in Q1 and Q2, but now they're starting to reopen, so we're starting to see perhaps new content creation coming out of their production facilities. Okay, not much here. What about the financials? Okay, this is interesting, competition. Let's see what they're telling us about competition. Of all the major entertainment companies like Warner Media, Disney, NBC Universal are pushing their own streaming services, and two of the most valuable companies in the world, okay, Apple and Amazon, are Apple and Amazon, they're also coming with their streaming services as well, introducing their own series, their own movies. Okay, investment premium. Okay, in addition, TikTok growth is outstanding, showing the fluidity of internet entertainment. Okay, so there is increased competition now. So they talked about Apple and Amazon, huge behemoth companies, and TikTok, but their situation on a geopolitical side with TikTok perhaps being banned in the US because the parent company is based in China, but now the CEOs of TikTok, they're starting to distance themselves from China. And as you can see, the Trump administration, they're starting to say, hey, this might be a national security issue because they're collecting a lot of data on Americans. So it's just on the political side, but we'll have to wait and see how TikTok, the situation plays out, if they actually get banned or not. If they don't get banned, then that is increased competition for Netflix. And the fact that they're mentioning Apple and Amazon being competitors is something that is quite, it should be a concern in the back of investors' minds, because they might probably be able to provide good content, good series, television for us to consume at a lower level. And these two companies are generating a lot more free cash flow, so they can go head on with Netflix and take away some of their market share. So that is a little bit concerning. That's something maybe that is in the back of investors' mind. And because of that, they might pay a lower premium on their valuation. In terms of cash flow and capital structures, let's see. Net cash generating in operating activities for second quarter was 1.1 billion versus a minus $540 million, okay, in the prior year. Free cash flow was positive for the second consecutive quarter, okay, almost $1 billion. Free cash flow was higher than net income due primarily to FX, okay, valuation, I'm not gonna go into that. Free cash flow profile continued to improve. Okay, I care a lot about free cash flow. In the stock analysis that I did, and we uploaded this lecture, we learned that in the last 3 years, Netflix burned a little over $7 billion in free cash flow in generating their own content, their own series to increase subscriber growth, okay? This year, they're saying right here, look, we have positive free cash flow. But going forward, once they reopen all of their facilities, they're gonna get back into the same routine of burning through cash so that they can have new content, new series, and continue to grow their subscriber base. But my main concern is, at what point are you guys just going to continue to be free cash flow positive? At what point are you going to generate a return on the investment that you have made from a CapEx standpoint? This is something that's very concerning, okay? So let me continue here. In addition, we pause, okay, so we understand that you guys paused the production. Give me a little bit more guidance on that. Let's see. Due to the pause in production, pandemic, okay, so cash flow break even positive compare, As we indicate, last quarter, 2021, we project, okay, so here, let me highlight this. Okay, this is important. In 2021, we project that full year free cash flow will dip back to being negative again, although we believe the free cash flow deficit will be materially better than our peak deficit. Okay, yeah, okay. So you're basically saying, hey, look, in 2019, we burned to 3.3 billion, but don't worry about that. We're still gonna lose money. Might be $1 billion, might be 2, but it's better than 2019, don't worry. As an investor, as a shareholder, I am concerned about that number. There has been no material change in our overall estimate timetable to reach consistent positive. There it is. I mean, they're telling us right here that they still don't know when they're anticipating that to reach consistent annual positive free cash flow, which was the point that I was making a minute ago. Okay. We often, and here we go again. I mean, now you're seeing the importance of free cash flow and why I've mentioned this. So we're often asked by investors what our free cash flow profile would be at steady state, or when our cash content spending matches our content amortization. The pandemic and the resulting pause in production provides one earlier snapshot of what that may look like. Okay. In Q2, okay, so that gave you a snapshot. I don't know. Look, I'm just going to discount this. I'm not going to take the coronavirus being a snapshot of what their free cash flow will be if they pause content creation. I don't think they've have giving us any type of clarity or more transparency on what that number is going to look like. So from an analyst standpoint, it's very difficult and is a challenge when we're forecasting their financial model, their cash flow statement, and what that's going to look like. This is why, this is one of the challenges part of being an analyst and then creating a financial model for a company like Netflix. Okay, so I think this is what I wanted to go over for the most part on the situation overview and the diligence part. It's really reading the press release on the quarter and what they are anticipating for the second half. So I guess the way we can summarize all of this is that in the first half, they had strong growth, higher than expected because of the coronavirus. Now in the second half, we can anticipate or predict slower growth because the first half took away some of the additional net subscriber that they were anticipating. So expect slower growth in the second half. Now, how does that weigh on the back of investors' minds? Well, now let's look at our model. Let's see what type of valuation we get, and also did they meet or did they miss Wall Street estimates? So that leads me now to step number 2, and we're gonna pull up our spreadsheet. Here it is. And there's a lot of things that I'm showing in this spreadsheet. The first part is right here, a very simplified income statement showing sales and earnings per share. And we're also going to do simple valuation analysis. In this case, sales multiple and PE ratio multiple analysis. In addition to that, we have comparable company analysis. This is coming directly from CapIQ, which we're going to use to help us come up with a reasonable multiple. As I scroll down here a little bit more, we have consensus estimates provided by Thomson Reuters, and this is giving us what Wall Street analysts are projecting for the next year, 2 or 3 years going forward on their operations, on their income statement. How many? We have that information down here. Here you go. How many analysts are covering them right here? 39. Okay, and then you can see also the mean and median price level or price target that all of these analysts have combined. How are they coming up with this? Well, sell-side analysts on Wall Street, when they build their models and they provide their projection, they submit that information to Thomson Reuters, and then within their own database, they get the average and median of their price target. Same thing for revenue projections, EBIT, EBITDA, net income, and even earnings per share and additional cash on balance sheet information. Okay, so we're going to use some of this stuff to help us anticipate what earnings are going to look like. And then how can we value the future sales and EPS of the business to give us an implied price target? In addition to that, if I scroll down here, you could see what on a quarterly basis the street was expecting. Okay, so here we have the mean is what the street was expecting. Okay, right next to it you have Q2. This is what they reported. And you can see that on the top line, revenue, right? They beat expectations. Okay, the street was expecting roughly 6 billion. They came in at 6.1 billion in revenue. So they beat on the top line. But on the bottom line, when you look at earnings per share, they miss. The street was expecting $1.81 on a normalized basis, and they came in at $1.59. This is why when we pull up the press release, if I scroll up again on the press release, you can see that down here. $1.59. You see here diluted shares, the shaded column, $1.59 is what they have right there. So that's also probably one of the reasons why the stock sold off after they reported earnings in the after hours. Okay, and also the projections of the business, right? What management forecasted, lower than expected subscriber numbers, which also impact your sales. In addition to that, down here we have analyst price target. So I went back and looked at what recommendations new analysts provided after they reported earnings. And you can see here, this was on Friday, and all the different investment bank sources that provided their price target. You can see here on a current basis, this is their new one, this was previous, and you can see the delta by how much they increase or decrease their price target. Okay, so if I highlight the bottom numbers, right, the mean and the median, you can see that for the most part, most analysts actually raise their price target on the company. When we look at the average and median of all of these analysts, how many in total? Let's calculate this real quick. I think this is almost about 15. Wow, 18. Okay, so we have 18 price targets from different analysts, and on average, they increase their price target by about 9%, and they're giving you a price target of $529. This is the average. On a medium, $539. Okay, you could take either one, or you could even run and take the midpoint. Let's say $530 would be the average price target as of July 17 from all of these 18 analysts that provided the information. And again, this is coming from the database Thomson Reuters. So I'm sharing this with you because then we're going to look at our own price target. So let me scroll up and come over here to my very simplistic analysis valuation. Okay, so we have sales, okay, and look at the years that I am looking at. We're looking at from 2019, that was last year, all the way out to 2022. And you can see what I have here for this year. The street is expecting 24.8 billion in revenue, which is a 23% growth from the previous year. Okay, in 2021, we are anticipating 29.1 billion in revenues, which is a 17% increase. Again, that number is coming from down here, right? You can see it over here. That's where I'm getting that information from. All right. And we also have earnings per share. You could see earnings per share growth. 2020, they're expecting $6.23. That's a 51% growth rate. And then the following year, 41% increase at $8.78. And again, I'm getting this information from Wall Street Consensus down here. You can see it. Let me pull up my pen and highlight it. Here it is. Here and here. Okay. So we have two variables. We have top line revenue growth and we have bottom line earnings per share growth. Now the question becomes, as an analyst or as an investor, what should you pay for that growth on a sales basis and a PE basis? So here we have two ways of valuing the business. We have valuation using sales multiple and valuation using PE multiple. On the left-hand side, quick comparable company analysis, you could see all the different companies that Capital IQ, which is provided by Standard & Poor's, thinks is a competitor to Netflix. All right, and then here you could see the sales multiple, enterprise value over sales. Netflix is trading at 10 times, and this is as of this Friday. The industry mean and median is between 5.3 and 3.9. There's one outlier right here though, Roku. Roku is trading at 14.3 and they're growing almost at the same rate as Netflix. Probably a little bit faster than Netflix, but still the market is paying a premium for Roku because of the growth rate of Roku. So the question becomes, what multiple should we apply to Netflix 2020 and 2021 sales? I'm making the assumption that we're gonna keep 10 times, which is what they currently have right now, right here. And then for 2021, I am going to make the assumption that this will decline because the growth rate is declining, and it's gonna be 8.5. Obviously, this is open for debate, but I'm just gonna keep it consistent with what they have right now, and then going forward, I'm going to say that it's gonna be 8.5, all right? If we take these multiples and we multiply by your sales, that's gonna give you an implied enterprise value. So take your sales, multiply by your sales multiple, okay? Revenue times your multiple gives you an implied enterprise value. You subtract your cash and equivalents from the most recent balance sheet. You take into account their also total debt from the most recent balance sheet, and that gives you your net debt. You take the net debt of these two, you subtract cash. Then you subtract from the enterprise value your equity value, your net debt, and that gives you an implied equity value. You take the company's shares outstanding, then you divide equity value by shares outstanding, and this gives you an implied share price or an implied price target on a 10 times sales multiple applied to 2020 expected revenue. You do the same thing for 2021. And you can see right here that on a sales basis, we are getting price targets for 2020 of 584 and for 21, 543. If we do the same process, but apply it to earnings per share using PE multiple. We are going to take the earnings per share of the company, right, for 2020 and 2021, and we're going to apply a PE ratio. This PE ratio right here, this 83, is just going to, I'm making the assumption that the market will pay the same for the end of this year, 2020. Then going forward for 2021, I reduce my PE multiple to 66.8. Why did I reduce it? Because I'm taking an analysis. I'm looking at PEG ratio. And that's what this is right here. PEG ratio, 1.6 times. What is PEG ratio? It's just price to earnings growth. So a 1.6 multiple PEG on the growth rate of the business of earnings will give you a multiple of 6.6. How does the math work? Well, let me press F2 here, and you can see the formula. Now, I know I'm getting very technical here, but I just have to walk you through that process so that you can understand where the numbers is coming from. And go back to the food lecture that I did on Netflix. I actually explained a lot of these things there. So see here how I'm taking basically my PEG ratio, 1.6. I'm making the assumption that the market will pay 1.6 times for the growth. So this 41%, multiply that by 1.6, and to convert it to a whole number, I'm also multiplying it by 100, and that will give you a 6.6 multiple. So if they're growing earnings at 41%, the market will pay approximately 66.8 PE multiple. And then to come up with my price target, all I'm simply doing is taking the multiple and multiplying it by the expected earnings per share, 8.68. And then do the same thing for 2020. I take 6.3, multiply by 83 times, and then look at the price target that I end up with. Okay? So on both methodology, sales multiple and PE multiple, I'm getting an implied price target of over $500. Now, again, this is a little bit more art than science. For those of you in our analyst program that have the sophisticated skills, then you would build out a DCF analysis. You will probably do a 10-year model for Netflix because they're still burning through a lot of cash. So you might have to have a 10-year model so that in your unlevered free cash on the DCF side, once you go through the next maybe 2 or 3 years, probably 1 or 2 years of negative unlevered free cash flow, at least you have 8 additional free cash flow and unlevered free cash flow that are going to be positive that you can discount to the present time and then do your perpetuity or terminal EBITDA method. So I would take these numbers, these price targets, okay? And let me ungroup right here. I have sales that I've grouped. So I'll take this would be sales right here, okay? And this one would be the PE valuation basis, okay? So I'm focusing more on 2021, all right? Price target. So I'm taking my valuation on the sales multiple side, and I'm also taking my valuation on the PE side. So you see right here, and again, this is more art than science, so I'm just gonna take the medium of those two price target, and that gives me a price target of 565. If I look at forward multiples, what's the forward multiple? Take the implied price target divided by 2021 earnings per share, and I get a 64 times forward PE multiple. Now the question is that a reasonable forward PE multiple for Netflix, a company that is growing earnings per share based on our estimates, 51% in 2020, 41% in 2021, and 37% in 2027. I think this is reasonable. I don't think this is too, I mean, some people might argue that this is on the high end and this might be quite expensive, but if you're paying 1.6 times the growth rate, I think this is reasonable. I think 64 times expecting next year earnings will give you 565 price target, give or take. I think this is reasonable. But then on the other flip side of the equation, you might say, okay, but what about the increase in competition from Amazon and Apple? What about the high level of cash flow burn rate? Do they have the flexibility to raise prices? I don't think they have that much flexibility in raising prices. So there's obviously two sides of the spectrum here. There's two different perspectives. I'm looking at what they're projecting, and then I'm just doing simple trading multiple valuation analysis. Other may do a DCF analysis and have a worst case scenario where they don't think they're going to hit those numbers. And maybe this growth rate will decelerate even more, not 23% growth. Some analysts might have a worst case scenario where that might be 20%. Then the 17% might actually be 10%. So play around with the numbers. Hopefully you can understand this process and you can play around with your own numbers so that you can come up with a simplified implied share price. Now, of course, we could go a lot more deeper than what you're seeing right here by building a full-blown model, doing a revenue buildup. How many subscribers they have times the average revenue per subscribers, what is their market penetration in the US and also globally. Again, we can go a lot more deeper, but for simplicity, I'm just walking you through this process. And if you see here my price target of 565, if we scroll down again to what other analysts are expecting, on the medium side, 539. So we are a little bit above that range. But look, there's other analysts right here that have $600 price target. You have right here undisclosed, so we don't know the bank is coming from. We have this one, Munnis, okay, 600. Wow, they have 500, and then they increase it to 600, giving them a 20% increase on their previous price target. We have someone else right here with a 610, okay, undisclosed. Anything else on the high 500? Okay. Well, this person right here reduced their price target from 625 to 575. Okay. But for the most part, you can see that most of the price ranges are in the $500 mark. Okay. So I hope that kind of helps you understand a little bit more of the thought process behind how we come up with some of these share price just by simply looking at the growth of estimates on sales and EPS and simply applying the expected multiple or a reasonable multiple that you think might be reasonable for Netflix. Now, the next step is, of course, to look at charts so that we can apply technical analysis and see where the momentum of the stock is. What is price action telling us? So let's open up our charts. Here we go. Here it is. So you can see that Netflix obviously came down on Friday after they reported earnings. But in the after hours, the stock actually traded much lower than this. Let's see if we can pull up aftermarket earnings. You see here? Here it is. They traded as low as 451. So the stock definitely sold off. Someone sold off a big block of shares to bring it down to 451. Okay, now let's apply technical analysis here, right? Let's go back to our daily. And we can see that this stock definitely completed an entire move to the upside, or what I like to call Gartley patterns. Your first wave, A to B, might equal your second wave, C to D, provided that we break resistance. We actually apply this process in May, and when we had a $500 price target. How do we do that? Well, from down here, okay, we applied also this will be resistance, and we said if we break resistance, this first wave would equals the second wave. And this is how we came up with I believe it was, we have about a $500 price target, or perhaps a 540. You may want to go ahead and check that and watch it so that, again, you can learn the process. But we got that one right, okay? Now, how can we anticipate the next move given price action? Okay, so if I turn this to the weekly, and we apply Fibonacci retracement. Let's see, this chart uploading. Yep, here it is. Okay, let's clear this drawing and let's apply Fibonacci retracement so that it can give us an approximation of where we can find some sort of a floor or support. If we come to the 38.2, it will be 465 support. That will be the first level on a Fibonacci retracement. The second level on the 50% would be 432. Okay. So I'm going to draw right here a zone. And it's actually right in line also where it broke from. Okay? Now let's go back to the daily. Okay? And let's remove the Fibonacci so that we can make this a little bit more clear. Okay. So this would be my support zone. All right? And we know in the after hours, the stock actually came down to as low as 441. Because I have a price target now on the fundamental basis of 565, let me highlight the sell, okay, of 565. That means that if we do get a bounce, okay, let me pull up this again. Let's maximize it. Okay, that means that if we do get a bounce, I would first like to see the stock actually come down to my support range, okay? And if we do get a bounce, we might get a bounce back to that price point, which would bring it around resistance, its all-time high, around 570. Okay, I could see this anticipation, I could see this playing out. But once it hits our price target, because they're slowing down in the second half, and also because of increased competition, and as we continue to reopen the economy, and people begin to go outside, the number of viewership might decline on Netflix. So that would set in motion reasons for the stock to come right back down to this range. And this would be the range that the stock will probably trade for the next 3 months until we get the third quarter earnings and we get more information out of management. All right. So this is how I will anticipate this move playing out. The first part would be, okay, come down to this range on an actual intraday level, right? I know we did it in after hours, but I want to see the actual stock come down to this range. If we're here, okay, expect a bounce. How far would that bounce be? My price target is, let's pull this back up again. What is it? 565. So let me just make a note. 565. Let's put it right here. Price target, 565. There, okay. So that will be my first price target. If we come down and we get a bounce, and then the market obviously continue to rally higher after these earnings seasons, but keep in mind that it's all about earnings right now. Now you have to see how Amazon earnings are, Apple earnings, Google earnings, Facebook earnings. Why am I mentioning these stocks? Because these are the heavily weighted stocks in the NASDAQ, and these are the ones that actually lead the market. So if these companies have worse than expected earnings, then this wouldn't negate this scenario. So this is probably my first scenario, scenario number one. Okay, scenario number one will come down to support, this range right here, and it actually comes in line with with support, which we also got it from Fibonacci retracement. If we get a bounce, that bounce might take us to 565 if it's a strong bounce. But once we're right here, I think the next catalyst will be Q3 numbers. All right, and then if we don't have Q3, if the stock is weak, then we'll probably continue and come back down to this range. That's scenario number one. Scenario number two might be that we get a temporary bounce. It may not be that strong, and then we sell back lower, and we might come down to this range right here. Okay, so this will be scenario number two. So scenario number two, in order to play out, then that might mean that the market is perhaps pricing in lower revenue growth, lower earnings per share growth, higher negative free cash flow, which is all negative, and of course, increasing competition. That will be scenario number two. All right, so mark this down, follow this process, study it, and do this on your own as well, and do it for any other company after they report earnings, and then just watch it so that you can have a game plan and execution in anticipation from what may happen, and you're not dancing or running around like a chicken with their head cut off. Not sure if that's the right analogy, but you have a game plan. It's methodical. We looked at the fundamentals. We apply some technical analysis. We apply some fundamental analysis by looking at sales multiple and PE multiple. And we also looked at what the street is anticipating for this stock. So I hope this provides value. I hope this teaches you something. And we'll see. If it hits 565, then at least you understand my thought process. Is it going to happen? Who knows? It's a 50-50. It's a coin flip, right? But we'll wait and see. So with that being said, I hope you enjoyed this lecture. I hope you understand the process, and we'll continue to do more like this. So, and by the way, if you have any questions, feel free to type them down and leave a comment below, and I'll be able to give you perhaps some more clarity on everything that we did right here. All right, folks? So with that being said, stay safe, take care, and I'll see you in the next one.